Stock analysis. Financial education basics. Financial education is one of the most important things to start learning from a young age. Starting young can have a huge impact on the end result. In fact, I think that at least a basic level of financial education should be mandatory in the education system. Having a basic understanding of how money works, who controls it, and how to protect it should be common knowledge. There are many people who do not even know what inflation means. Inflation essentially means that the value of money decreases. For example, let us assume that an egg costed $1 a year ago. The same egg has a price of $1.5 today. If we calculate how much of an increase this is, we find that this is a 50% increase in price. This means that if you had $3 a year ago, you could buy 3 eggs, but now you can only buy 2 with the same money. Now, if we look at this objectively from a broader perspective, we can ask the question why? Why has the price of the egg increased by 50%? The answer to that is the government keeps on printing more and more money, causing the value of money to decrease. Most people will not even think this way, to question this price increase. Financial education also teaches you this new way to question and think. Now comes the interesting part. How can we avoid inflation? This process of avoiding inflation and giving your money a chance to grow is called investing. There are many types of investments an individual can make. Some of the most popular ones are real estate, bonds, precious metals, commodities, forex trading, mutual funds, exchange traded funds, and finally stocks. I will be mainly focusing on stocks, also known as shares. These stocks are traded on the stock market. You have probably heard of NYSE, also known as the New York Stock Exchange. This is one of the largest places where these financial instruments are traded. Essentially, when you buy a share in a company, you own a very small percentage of the company itself. When you make this purchase, you are considered a shareholder. Some companies even pay you for just holding onto their shares. This payment is called a dividend. Investors who particularly invest in stocks with high dividend yields are known as dividend investors. As a company makes a larger and larger revenue and keeps on growing, the stock price of the company will also follow the trend and increase in price over the long term. The process of analyzing income statements, balance sheets, and cash flows allows you to find a company with the potential to grow over the long term. This process is called fundamental analysis. Just like fundamental analysis, there is another way of analyzing stocks. This process is called technical analysis. Technical analysis focuses purely on price movement to find patterns and trends to find the perfect time to buy and sell. I will be focusing on fundamental analysis since it is for long-term investing, which is the better option in my opinion. There is also a difference between investing and trading. Investing is long-term with a time frame of minimum 2 years. Trading ranges anywhere from minutes to months. In the long term, the stock market tends to have a positive trend. But if we look at the short term, the market tends to be volatile and very hard to predict. I would even say that trading can get very close to gambling if you are not educated enough. Now that you understand what all this is essentially about, you may think, how do you really start investing? Before you start investing, there are a couple of questions to answer. These answers will be very useful for picking the correct stocks to buy in your situation. The first is your age. Age has a very huge impact on what you're able to invest in. If you're under the age of 25, you can make riskier investments. If you're between the ages of 25 and 50, you can take moderate risk, and if you're over 50, you have to play it safe. Simply put, the younger you are, the more risk you can afford to take, since you don't have too many financial responsibilities. You also need to understand that without taking risk, you cannot expect to make good returns. The next question is, what is your goal with investing? Is it to make passive income, like I mentioned before with dividends? Is it to secure retirement? Is it to learn a new skill? These are just a few examples. There are thousands of answers. Now comes a hard question. How much of a loss can you handle? This essentially comes down to your personality. There are people who can stay composed while others panic after seeing their stocks plummet. If you cannot handle a 50% loss, you should not be investing in stocks. You should just stick to exchange traded funds and indexes such as the S&P 500 and OMX C25. You should also be aware that there is a small chance that you lose all the money that you invested. There is nothing guaranteed in the stock market. After considering all the risks, if you end up deciding to just invest in indexes, it is totally fair. But if you decide to invest in stocks, you should also know that you should only invest with money that you have in excess and not really needed in the next 5 years. Now that you have a basic understanding of the stock market, I would also like to mention the fact that you have to be very skeptical about advice in the financial sector generally. All this was just an introduction. There is so much more to learn about the stock market. Next time, I will be analyzing a company using its fundamentals.